In the first 4 days of trading, SPCX stock jumped 49%. The offering raised $75 billion in a single day, making it the largest IPO in human history. This one-day total broke the global record previously held by the 2019 listing of Saudi Aramco. That initial surge pushed the company's total market value to $1.77 trillion. A valuation of that size means SpaceX is now worth more than established legacy giants like Berkshire Hathaway. Analysts at Wedbush are describing this as a critical infrastructure layer for the global AI revolution. Buying into the largest IPO ever recorded requires you to pay a massive premium today for perfect execution tomorrow. To understand if that premium is justified, we have to look past the market momentum and focus on the physical balance sheet. This chart compares that trillion-dollar valuation against the operational reality, a confirmed $8.7 billion loss over the last year. Investors are currently choosing between unstoppable institutional momentum and these specific fundamental metrics. We need to calculate which specific type of investor can actually absorb this level of risk. Evaluating an unprofitable company requires looking at the price-to-sales ratio. SpaceX currently generates $18.7 billion in total annual revenue. That revenue base results in a valuation of 94 times sales. For context, Apple trades at 8 times sales. This comparison matrix highlights the gap in fundamentals. Apple produces $100 billion in annual profit. SpaceX is currently losing money. That deficit is weighed down further by the xAI merger, which adds an estimated $6 billion in annual cash burn to the company's expenses. Operational stability also rests on a single, highly visible CEO, whose public actions can influence the stock price. At a $1.77 trillion price tag, any launch delay or CEO controversy will likely trigger a rapid downward correction in the share price. There is also a structural threat built into the market mechanics of an IPO, the insider lockup period. This period, which prevents early investors from selling their shares, is set to expire for SpaceX in December 2026. When the lockup expires, millions of private shares flood the open market as early backers look to cash out. Uber's stock price dropped 30% shortly after its initial lockup period ended. Lyft faced a 40% collapse under similar structural pressure, despite the early hype of its debut. Projecting those historical trends onto the SpaceX timeline points to a significant price risk in December 2026. This expiration date creates a structural gravity well, making it probable that early buyers will see their shares diluted by a sudden 20 to 40%. The immediate revenue engine is the Starlink network, which currently serves 6 million subscribers and is growing every month. Analysts estimate that Starlink, as a standalone entity, could eventually justify a $1 trillion valuation. Guaranteed multi-billion-dollar contracts with the Pentagon and NASA provide a defensive financial moat that most tech companies lack. The company's 50-year roadmap includes data centers in orbit and the colonization of Mars. Purchasing SPCX stock funds a monopolistic, multi-decade infrastructure project that operates outside the usual cycle of short-term expectations. The final decision to buy this stock depends on your personal time horizon. If you are an investor who needs this capital within the next 24 months, avoid the stock for now. The risks associated with the lockup expiration are too high for a short timeline. On this timeline, you are likely to face an inevitable insider sell-off that will erode your initial investment. For those who can commit capital for 10 to 20 years, the outlook is different. Approach SPXX with the same risk management mindset used for early-stage venture capital. A standard risk mitigation strategy involves limiting the position to a maximum of 2 to 5% of your total portfolio. This small allocation allows you to weather the expected price swings of the next 3 years without liquidating the position out of fear. Investing in SpaceX is a trade. You are giving up near-term capital efficiency in exchange for a long-term stake in a technological monopoly. Just make sure the math allows you to stay in the game.